I'm Ed Highland for Money Talks America at the NABE Policy Conference in Washington, D.C., the National Association for Business Economics. I'm joined now by Richard Brown, who's the Chief Economist for the Federal Deposit Insurance Corporation. Richard, thank you so much for joining us here on Money Talks America. I want to talk a little bit about lending. A number of lending institutions have been cutting back. In fact, most everybody seems to be cutting back in the way they're lending money to people. Lowest level I've heard since 1942 in the amount of money that's being lent to people. And obviously that's a real crunch on the economy. When people can't get the loans, when they can't buy the houses, then it brings the whole process to a halt. Tell us a little bit about what the FDIC is doing right now to get that money flow going.
Well, lending is the reason banks are in business and the reason why FDIC stands behind the deposits of those banks. And we saw loan balances fall by 7.5% last year, as you mentioned, the highest since 1942. We've seen lines of credit cut back sharply because of tighter lending standards. We've also seen the value of collateral, real estate collateral in particular, fall, and that's reduced the creditworthiness of some borrowers. At the same time, the demand for credit also has been less by business borrowers. They're reducing inventories and business spending, and households want to clean up their balance sheets. So it's really all of those going on at the same time.
So it really is a combination of the consumers being in trouble as well as the banks being in trouble.
Well, I think so, and loan demand should come back with a recovering economy. And I think the important thing is for banks to repair their balance sheets and get themselves in a position to meet that credit demand when it comes back as anticipated later this year.
And one of the things that was mentioned by members of the Federal Reserve when they were speaking here is that a lot of the money, the liquidity that was put into the system is kind of sitting idly at this point in time. Are you foreseeing a time when some more of that is going to be pulled into the system before the Fed pulls it out of the system to ward off inflation?
Well, that's a typical thing for banks to load up on liquid assets and securities during a period such as this when the economy's been slow. And I think once we get a recovering economy, and especially when interest rates start to rise, banks will have an incentive to expand their loan portfolios and book new business at higher rates of interest. In terms of the inflationary implications, those are excess reserves, and it's something that the Federal Reserve is working with to make sure that those are managed going forward. It's a bit of a new, novel situation given the crisis response, but they're announcing plans to deal with those excess reserves as time goes on.
A lot of this thing started because the financial institutions were in serious trouble, and we were talking before the tape started rolling about too big to fail and how that's something that you're trying to work out of our lexicon, if you will. I want to talk a little bit about the number of banks who are failing at this particular time. It's still a very, very high number. Is the entire financial institution, is it still on pretty shaky ground?
Well, the industry as a whole, the vast majority of institutions are making money and are in good financial condition. We did see the number of problem institutions rise during the fourth quarter from 552 to 702. It's the highest level since the early 1990s. Now, to be sure, not all of those problem banks will fail. Historically, just under 20% of problem banks have failed over the course of that time. But we expect to see elevated levels of problem banks for some time as the credit distress continues to work its way through the industry. And we'll see the level of bank failures remain elevated for the time being, again, as some of those institutions do not make it.
Now, when a bank fails, often FDIC gets stuck. I mean, you are in a position where you're going to have to take care of the shareholders and make sure the assets that are there are protected.
Not the shareholders. So we stand behind the depositors.
Correction,
to be clear.
thank you.
Insured deposits up to $250,000. And so the FDIC then looks to place those deposits with an acquirer, if at all possible, keep the assets with the private sector, and provide continuity to local borrowers and as well as those depositors. Their window stays open. On a rare case, we'll have to pay them out, and we'll just go ahead and write a check to the depositors. So we work very hard to market those institutions. We've been pretty successful at it, and it's really a non-event for depositors. It's business as usual. It closes on Friday, opens up on Saturday or Monday as a new institution, and it's really not a problem for depositors.
When I give my money to somebody, I think of myself as a shareholder, so that's why I mentioned that. But you raise a good point. If you're going to be assisting the banks, if you're going to be making sure that people who have deposits are covered, then how is your checkbook doing? How is FDIC going to be able to handle increased bank failures and continuing bank failures?
Well, managing the balance of the Deposit Insurance Fund is something that we've been working with for the last couple of years. The balance actually has come down to negative territory, but that's not really the constraining factor for the FDIC. We have the backing of the full faith and credit of the U.S. government and a line of credit at the U.S. Treasury if needed. The constraining factor is really cash, and so we asked the industry to prepay 3 years worth of deposit insurance assessments at the end of last year, brought in $46 billion. So our cash reserves at the end of 2009 were $66 billion. That's plenty of cash to deal with the caseload that we have right now, so there's no question about our being able to act. And so I think we're in a good position to meet the challenges that are in front of us.
On that note, Richard Brown, Chief Economist for the Federal Deposit Insurance Corporation, thank you so much for joining us.